Every home closing hides a fee few buyers question, yet title insurance quietly drains billions through a system built on repetition, opacity, and fear. To many buyers, it looks like protection. In practice, it is a legal product sold once, after the risk has already been mostly searched and priced. The line item appears near the end of closing, small enough to ignore, large enough to hide a market structure. A homeowner pays for a policy tied to past records, not future repairs, yet the premium is collected as if catastrophe is likely. The real work is a search through records, liens, and ownership history. But the charge often reflects market power, not just labor. Most policies never pay a claim. That is the first hidden fact: the product is priced like insurance, but behaves more like a transaction toll. Why does it exist at all? Because property records are fragmented, inconsistent, and often old enough to create anxiety for lenders and buyers. The premium does not stay in one place. It is split between underwriters and agents, with each layer taking a cut from the same closing. In many states, rates are filed, approved, or only loosely challenged. That is where regulatory capture can settle in and stay for years. Buyers often see two policies, one for the lender, one for themselves. The lender policy is mandatory, turning a risk problem into a guaranteed sale. The lender insists on protection, but the buyer pays. That asymmetry is not accidental, it is institutional design built into the mortgage process. Settlement firms bundle title search, escrow, recording, and closing support. Bundling sounds efficient, but it can also conceal profit centers inside one invoice. In some markets, the same corporate family owns multiple links in the chain. That concentration makes hidden margins harder to see and harder to challenge. Economists would call this rent extraction, money collected not because value is extraordinary, but because the system allows a gatekeeper to charge for access. Claims are relatively rare, yet the premium can be substantial. That gap between expected loss and billed price is where the hidden margin lives. When payouts are low, the business can look remarkably stable. Stability is not the same as efficiency, especially when prices are protected by regulation. Fear sells the product. Buyers are told that hidden liens, forged deeds, or old judgments could explode later, so the safe choice feels mandatory. The industry also depends on referral networks. Real estate agents, lenders, and attorneys can steer business toward preferred vendors, quietly controlling the flow. In some places, those relationships can blur into kickbacks, affiliate fees, or cozy vendor arrangements. The result is a market that rewards loyalty over transparency. This is where regulatory capture matters most. Rules meant to protect consumers can become shields for incumbents, preserving the same pricing structure year after year. Technology should have crushed costs. Digital records, instant searches, and automated indexing should lower overhead, but legacy rules slow the shift. Instead of open competition, many states preserve old methods through statute and licensing. That institutional design keeps the fee higher than it needs to be. Buyers rarely shop title insurance like they shop appliances. The decision is embedded in a closing process that pressures speed over scrutiny. The policy itself contains exceptions and exclusions in fine print. That means the buyer pays for protection that can still leave major gaps. Title risk is backward-looking. It comes from the past, from record errors, inheritance disputes, and unpaid obligations buried in the chain of ownership. The economics can be brutal: low expected losses, high perceived necessity, and a closing process where the consumer pays without real negotiation. A few large players dominate much of the market. Concentration strengthens bargaining power and makes it easier to preserve profitable fee schedules. In many counties, local control matters. Limited competition means consumers are choosing from a narrow menu, even when the service sounds optional. The closing table becomes a place where small add-on charges accumulate. Each line looks minor, but together they widen the hidden margin. Why does the fee survive? Because most buyers only see a single transaction, not the broader system of repeated legal and financial extraction. Public records could be cleaner, faster, and more open. If the data were truly accessible, the justification for high charges would weaken fast. Real reform would unbundle services, publish real cost data, and force honest competition. That would challenge the institutional design built to hide fees. Transparency would not eliminate risk, but it would expose price padding. Once buyers can compare, the hidden ledgers become far harder to defend. The business works because a single home purchase can feed multiple revenue layers. Agents, underwriters, affiliates, and vendors each take a piece. The result is a business where buyers pay once, while hidden margins compound across agents, underwriters, and affiliated service channels. Title insurance is not just a fee. It is a lesson in systemic flaws, regulatory capture, and who profits when complexity goes unquestioned. Subscribe for more.